Data from second quarter 2011 is in, and the results from the U.S. apartment market look very, very good. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons, and I'm with Greg Willett, the VP for Research and Analysis at MPF Research. And let's get to the bottom line number. Revenue change in second quarter measured 2.5%, a very impressive result, and that combines the increase in occupancy, which was 0.8 percentage points between March and June, as well as the same-store increase in rental rates, which was 1.7%. So, Greg, turn into the old guy in the room. You've seen a lot of market cycles. So how far back do we have to go to see this kind of revenue growth number in a quarter?
Well, Jay, let's get in the time machine and go all the way back to the dot-com era.
Oh.
It was really in 2000 and early 2001, the last time we saw revenue growth numbers like this. It was a pretty different situation at that point, though. Back then, we were seeing some really huge numbers from a handful of tech-heavy markets. Mm-hmm. Right now, though, it's a much more balanced situation, solid momentum across almost every market, and the overall number for the U.S. looks really strong, partly just because we don't have very many markets pulling the number down.
And let's look at some of those numbers. Here's a chart showing occupancy in the U.S. The overall rate is at 94.3%. Again, as I noted earlier, that is up 0.8 percentage points since first quarter. So getting there to that number must have meant a very significant demand number in second quarter. What do those results look like?
Yeah, the demand numbers are really big in second quarter, and we're still doing a little bit of cleanup on the supply-demand stats, so these might change a little bit, but absorption really in the neighborhood of 100,000 units for the quarter. Show you a graphic here with the dozen or so leaders in demand on the metro level, and you'll see these top 12 accounted for more than half of the total demand across the U.S. Some highlights there. Dallas-Fort Worth, very strong at more than 8,000 units, 6,000 units or so in Chicago, New York, close to that in Los Angeles, and more than 5,000 in Atlanta, which is really the surprise of the bunch because that one really had shown no momentum at all for the previous three quarters.
Greg, let's dig a little deeper. What's driving that strong demand and occupancy growth?
A couple of factors come into play there, Jay, and one of them is really low churn in the resident base and some really strong retention as leases are expiring. And that was certainly the situation in 2010. We were a little bit worried about that as we came into 2011. However, as rents started to rise, it was certainly possible that we were going to see turnover start to pick up. Last week, I was at the National Apartment Association conference and did a session that with about 40 or so CEO, COO level apartment operators, and it was interesting, not a single one of them reported any increase in turnover so far this year. That resident retention rate is remaining really high. Another thing that's coming into play in these numbers, Jay, is that we're starting to get some good demand in the bottom half of the market. We came into this year with top-tier product pretty close to full, and it really remains performing really well. But new to the mix is that we're starting to get some absorption for the bottom-tier properties, and that is a really good sign that we've had some decent job growth for young adult households, and that's really helping the overall market tighten up. Top tier, again, better performers, but that gap has closed up over the past 6 months and really even just during the past 3 months.
Now let's turn to the pricing story. Here's another chart for you looking at rent change. Same-store rental rates in second quarter improved 1.7% in the U.S. as a whole, and that took the annual increase to 3.8%, a very solid number. Greg, what jumps out at you when you look at those rent numbers?
Well, it's important to realize that we started the rent growth trend 5 quarters ago. So that really means this is the first quarter where we've dropped off a positive number from that annual calculation. So to keep that annual number going up, we had to do better than the 1.2% that we saw in the middle of 2010, and we actually managed to do that in middle of 2011. Another thing we're seeing in the numbers, Jay, is that we've had some shuffling of the metro level results. Some of the markets that had been really high flyers recently now have plateaued a little bit, and some of the ones that were struggling a little bit in the past now have started to gain some momentum. So That's something that we're going to be talking about a whole lot during the course of the quarter when we do videos on some of the individual metros. So let's look at some of those numbers. And, last week while I was at the NAA conference, you hosted a session at the PCBC Multifamily Trends Conference, talked about rents. You certainly had some good news for the folks out there in San Francisco.
Yeah, it was a happy audience. Very, very strong rent growth in the Bay Area, but really not just there, but all of the Pacific Northwest. Take a look at our metro-level leaders for annual rent growth as of mid-2011. You'll see San Jose is now well into double digits, annual rent growth of 12.2%, and that number is really driven by a big jump in second quarter, rent growth of more than 7% just between March and June. And then on an annual basis, rents are up 6 to 8% in San Francisco, Seattle, Oakland, and Portland, and also a couple other spots outside the Pacific Northwest, Austin and Pittsburgh, and some other places that are starting to post some notable rent growth north of 5%, Minneapolis, Chicago, and Denver, as well as Boston. Greg, let's put the bow on the data. Now that we've had a very strong 2Q, does that change our forecast at all for the rest of the year and going forward beyond that?
The big picture number I think really doesn't change. As we were coming into this year, we were forecasting revenue growth of about 6%, really the same thing for next year. The one thing that is maybe a little bit different, occupancy might improve a little bit more than we were anticipating. That reflects a couple of things. One being that limited churn, which we've already talked about. Another being that while we've had a lot of construction announcements, those properties aren't getting started physically, coming out of the ground quite as quickly as we perhaps thought. So we're not going to have an uptick in new supply in late 2012. Now, that's really in most metros not going to come until 2013. On the other hand, the rent number might be a tiny bit lower than we had originally thought, and that's really coming in with operators being very conscious of getting some good momentum on rents, but not pushing them up so high that you're risking losing some of your best renters.
Thank you, Greg. And one thing we should note is these results do reflect our preliminary data for 2Q. The numbers could shift, but not by more than 1/10 of a point or so. Certainly the overall stories remain intact. And join us starting next week. We'll start looking at some individual metro highlights, and we'll be doing that for the rest of the quarter. So until then, for Greg Willett and for MPF Research, I'm Jay Parsons. Thank you for watching Apartment Market Dynamics.
Want more? Go deeper with MPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, MPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Report.